Good evening and welcome back to Beerage. Today morning on Monday, the markets opened bright. But as soon as the markets opened, news from China was very somber. Month of April, the numbers, especially the GDP numbers from China and the purchasing PMI index and whatever indices you track, showed that China's growth had declined badly. The Chinese index, the Hang Seng, and the Nikkei fell immediately. What it is very clear is China's zero COVID policy is hurting very bad, and the prices of the metals in London Metal Exchange are set to fall today because if there is no demand in China, then there is no way metals can sustain this high price. Also, this is negative for oil and crude should also correct. Only European Union sanctions on Russia will keep Brent alone high. Apart from that, things will be cooler as far as metal prices are concerned. Xi Jinping had announced that he would do heavy infrastructure spending to counter the Chinese slowdown. But the way the Chinese COVID infections are spreading, there is no hope of him starting anything related to infrastructure in the near future. Therefore, demand for metals is going to cool. Even though most of the export industries in China are working in a bubble, there have been repeated breaches of the bubble in various parts of China. Tesla had one of its parts delayed due to the COVID breaching a bubble at a supplier's factory. Therefore, the supply of Tesla cars from China has stopped and stalled. This is only a small indicator. The United States and Europe are heavily dependent on China as a factory for the world. In fact, most of Apple's productions come from China. This means there are going to be large supply chain issues. The shortage of consumer goods in a red hot consumer market in America means prices will further rise. This means there will be no cooling of inflation due to easing of supply chain constraints. Prices of consumer goods in the United States and Europe are expected to remain high. Also, in Europe, which having decided to ban imports of oil from Russia means higher energy prices. An already higher inflation will be stroked higher both in Europe and America. What does this mean? This means that with the Fed tightening on all cylinders, by which I mean they are not only increasing the federal Fed rate but also shrinking their balance sheet by buying lesser bonds when they mature. In fact, the Fed has said it will start tapering its bond holding by $95 billion every month. This means over a period of 1 year, $1 trillion would vanish from the Fed's balance sheet. When money is taken out of the Fed balance sheet, this means lesser money supply in American markets and also global markets because the dollar is truly a global currency. This will mean lesser money to go around and lesser money in circulation. This should lead to a recession, which is what most economists are forecasting that sometime in the middle of next year, America will go into a recession, and this recession is going to be extremely deep. Why is this recession going to be deep? Because in previous decisions, the US Fed had the power to cut interest rates to zero and print money to stimulate demand. However, as in this case, inflation is already running extremely high and the Fed has just begun an interest rate hiking cycle, which means the Fed cannot loosen its tight monetary policy when the recession hits. It will have to allow this recession to continue for more than 6 months before responding. In economic terms, a recession is defined as 2 quarters of negative growth. Already, America has had 1 quarter of negative growth, primarily due to the fact that trade deficit was extremely high. However, this did not reflect in the labor demand because the jobs market was very robust and whoever wanted to employ got employed and wages were rising. This means that both the mandates by which Fed can cut rates, one is jobs and the employment numbers, and other is inflation. Both are running way above Fed's acceptable numbers. The inflation has to come down to 2%. There is a model floating around in the United States which says even if Jerome Powell increases interest rates up to 2% this year, inflation will not fall below 4% and is going to get sticky at 4%. And the final 50% cut from 4 to 2 is going to take a lot of effort. So one can expect this interest rate tightening cycle to continue at least for a year, if not more. By then, if the Fed has increased rates to 3%, an immediate reversal is not possible, and thus there is an extremely high chance of a deep recession. Anybody who is operating in America should be prepared for a deep recession. The consumer should be prepared for a deep recession. If it does not happen, so be it. It's not baked in clay yet, but there are the chances of a very high recession in the United States are very bright. What it means for the rest of the world is when America sneezes, the rest of the world catches cold. So one can look forward to lower and more reasonable asset prices across the world, but there is going to be a growth slowdown across the world. Thank you for watching Be Rich. If you like this content, kindly consider sharing with your friends and relatives. And do not forget to subscribe to our channel and turn on the bell notification. If you do not turn on the bell notification, you will not be notified every time we put out a video. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support.